Federal Reserve raising by 1/4 point, by 25 basis points.
We are still seeing elevated levels of bank stress.
The Fed's balance sheet did rise again by $94 billion, not as much as last week, which went up by nearly $300 billion.
Our base case remains that they will get one more hike in at the May meeting, but that obviously depends on financial stability issues and bank turmoil, becoming under control and the Fed regaining control of the narrative.
Spring officially started this week. However, winter blues in the banking sector continue to cast a shadow. In light of what's going on in the banking system and economy, what does the Fed do here? How will Bitcoin prices be affected with all this? To answer all your doubts away, in today's video, Raoul Pal talks about the Fed's latest decision and the crypto market. He has also highlighted his viewpoint on the Fed's balance sheet, so stay tuned till the end of the video to know more details. And if you haven't joined our community yet, be sure to subscribe to my channel for more latest updates on economy, crypto, and market trends. Let's dive into the video now.
My view is the Federal Reserve probably do 25 basis points this time around because they want to show this relationship of, hey, we got Fed funds above inflation, so you can forget about inflation expectations. And the next move from the Federal Reserve will be 100 basis points emergency cut. And it might even happen as soon as June. Just depends what happens to the banks over the next few weeks. And then they just keep cutting and QE comes back. So that is why the equity market has not been falling. Is something I've been talking about for a while. Is equity market is forward-looking. The Nasdaq's more forward-looking than the S&P. The Nasdaq already priced in a recession, and it priced it in by October of last year. And it's forward-looking, so it's starting to say, well, liquidity is coming back into the system. Crypto is even more forward-looking, and that's why a lot of crypto bottomed in June. The rest bottomed in October. So that's forward-looking. So asset prices will go up because you're lowering the value of the denominator. So optically, it goes up. The only two that actually outperform the Fed balance sheet is crypto and tech because they've got secular trends behind them. Does it bring inflation? Okay, so let's say the Federal Reserve cut 300 basis points, do quantitative easing to take some of the shit off the balance sheets of these smaller banks and help the larger banks. Well, are they going to increase their lending or not? There's almost zero chance. We've seen this exact playbook in Europe. It's the same thing. So Europe 2012 is exactly the US in 2023. And what happens is they stop lending and they'll never lend again. And so that's the end of that story. And so if there's less lending available, then inflation is not available. You've also got, as I said, we've got unemployment to come, rents to come down, wages to come down. It's all part of that flow of time, how this happens. So the probability is, look, if they do all of this stuff, in 18 months' time, we're dealing in the inflation numbers because of this lag with rents coming down. And they're going to come down a lot because we've seen it from the Zillow stuff. Wages also. So in 18 months' time, we're still going to see massive disinflationary pressures, even though commodity prices might have bottomed and started rising. And that tends to be why the Federal Reserve and the central banks end up doing loose monetary policy for at least 2 years after the bottom of the business cycle, because you get these lagging effects of unemployment and rents. And unemployment is so political that they have to show that they're doing something, because in the middle of this is every 2 years in the US is this political cycle as well. So it's a complicated mess. I don't think it's inflationary, but I do think asset prices rise significantly.
The Fed announced a 0.25% interest rate increase, largely in line with where expectations finally settled after having fluctuated substantially in the past couple of weeks. As of now, expectations are for the Fed to leave rates alone when they meet in May, and then cut rates in June. After the latest 25 basis point rate hike by the U.S. Federal Reserve, the total rate hikes in the past 1 year has reached 500 BPS to 4.75 to 5%, a new high since 2007. But Raoul believes that the Fed will have a 100 basis point emergency cut in the upcoming meetings. Let's get into the next clip to hear more from Raoul Pal. Also, don't forget to like and share.
What they're trying to do is slow the business cycle down, because that's how you get rid of inflation. Now, always at the bottom of every business cycle, whether it was 1990, 2000, 2001, 2008, 2020, always something breaks because of rates and a slowing economy. So that's just a function of what happens in a business cycle, much like there's a boom at the peak of the business cycle and usually kind of excess leverage and excess optimism. So I don't think they tried to break it. Now, it's coming out that, obviously the Fed kind of knew that the regional banks weren't great. We also know the pension system's a problem. We also know there's a number of things that can be a problem in this system when you've got a globally indebted situation like we've got today. The world has never been this far in debt, and no country in world history has ever been as far in debt as the US is as a percent of GDP. So it's problematic.
The U.S. central bank is walking a tightrope between continuing to raise rates to combat high inflation, the biggest U.S. debt in history, and stepping on the brakes to prevent further upheaval in the commercial banking sector. Overall, the U.S. central bank's liabilities have increased by $393 billion in the last 2 weeks to $8.734 trillion. That is closer to an all-time high of $8.95 trillion a year ago, when the Fed started its quantitative tightening program and reduced its assets by $600 billion. You see, it took us 12 months to get $1 trillion off the balance sheet, and we basically gave back a third of it. Should we expect the central bank's balance sheet to expand over the coming years? Let's see what Raoul Pal has to say on this matter.
They have to pay the interest on the debt. So you pay the interest on the debt, that keeps increasing the balance sheet. So it'll go up another couple of trillion over the next 18 months or so. But if you get any shock in the middle, it actually boosts it more because they need to do extra, which is why the pandemic tacked on another 2.5–3 trillion on the balance sheet. So maybe this will tack on another trillion on the balance sheet, 2 trillion. We don't know. We don't know yet. We need to see. But the commercial real estate market on these smaller banks is about $2 trillion. Now, obviously, not the whole lot's insolvent, blah, 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 but easy to assume there's another $1 trillion get tacked on here, plus the payment of the interest payments. So it wouldn't surprise me if we don't see the balance sheet at $12 trillion in 2 years' time. So it just keeps going. There's no way to stop it. You can't reduce the balance sheet, which is increasing the value of the denominator, without asset prices optically going down. People say, oh, the Federal Reserve, they want to kill this asset price inflation. There is no asset price inflation. It's the denominator going up and down. So, and even PEs are a function of this, and I can come on to that later. So if they lower the value of the assets, shit blows up. Duh, it's collateral, right? In a debt system, you have interest payments and you have the collateral. If you lower the value of the collateral, guess what? This part blows up. And so they can't do it because the US is 220% of GDP in debt. At that level, then add financial debt and it's over 350% of GDP. So you cannot allow for the collateral to go under. It can't fall too much. If the collateral fell 50% this time around, the meaningful collateral of the system, stuff like the S&P 500, equity stuff or real estate or stuff like that, they can't allow it because the whole system breaks. So what they need to do is they can bring it down somewhat to slow down the economy. It tightens credit standards, but then they immediately have to reverse and go the other way, and they have to go further than they've been. And it's just an endless stair step of them doing this, and there's no way around it.
The U.S. banking system appears to be stabilized, for now, following extraordinary government actions to head off an all-out disaster after Silicon Valley Bank's failure. Yes, but Wall Street economists and the Fed increasingly expect fallout from that collapse to linger in the months ahead, as regional and community banks ease up on lending activity. No one knows, however, how big of a credit crunch is ahead and to what extent it will crimp economic activity. What are your thoughts? How will the banking crisis change the economic outlook? What will be the Fed's next decision? Can we see Fed rate cuts in the coming months? Let me know your thoughts in the comment section below. For more latest videos on economy, crypto, and market, be sure to subscribe to my channel. You can also hit that bell icon to never miss any video. Also, be sure to give this video a big thumbs up. I'll see you guys in my next video. Adios, and thanks for watching.